Hey, how's it going, guys? Garcia here with your daily portfolio update. So in this video, I'll break down the portfolio, show you the moves that I made today, share some of my posts from Twitter, and give the shoutouts at the very end. Okay, so today we are down to $172,426.83. So if you can, please hit the like button, leave a comment down below. Let me know if you enjoyed the video, any feedback as well. All right, so let's take a look at the small account. This one was down 4.7% today. So it was a rough day. But Tesla had their earnings call today, and this portfolio will look a lot different tomorrow. So year to date, we're up 59.7%. And all time, we're also up 59%, going back to April 11th of this year. So in this account, Rocket Lab and Enovix, those are the two two companies that I hold shares in. In TSLA, my exposure is in these long calls. So currently, the current value is $248 each contract. Average cost $270. But if I simulate my returns for tomorrow, if TSLA and Tesla hold their gains right now, we should see these jump up to $371 per contract, giving me a total return of $400. So we'll see tomorrow. We'll see if it matches up the reality, given the IV crush and yada, yada, yada. We'll see if this 992 market value goes up to 1,400. Okay, so let's take a look at the Roth IRA. The Roth IRA, we're down 4.4% today. We're up 41.4% year to date and 41% all time, going back to December 22nd of last year. Okay, so in this account, here's our Rocket Lab and Enovix position. Let's see the percent change. Yeah, so Enovix had almost a 7% dip today. Rocket Lab with a 2% dip. And then in this one, we have exposure. We have $6,000 in Tesla calls expiring June 2026. Now, the idea with these calls is the plan, and I think the plan will change between the accounts. I think with this account, as soon as Tesla starts hitting overbought conditions under a year, I'll just make the switch to shares immediately. Whereas in the taxable account, I might wait and let the rotation, let time pass until it's been 1 year old of 1 year of holding for long-term capital gains. And then after that happens, then I would sell the calls, hopefully at a profit, and then buy Tesla shares with the gains. Whereas here, in these calls, so we have a market value of the current value of the contracts are $3,058 each. Tomorrow, if the gains hold and IV crush isn't so bad, they should be worth $4,200 each, meaning I should have a gain of $2,000 on this account. So not too bad from going from negative $200. Okay, now to the main account. The big account was down 1.7% today. We're up 43% in the last 3 months, 124% year to date, 144% in the past year, and 74.5% all time, going back to August 2nd of 2021. I mean, it's just crazy to think about how this account was $50,000 back in January 22nd of this year. Damn. Okay, so buying power has gone up. What did I do on this account today? I bought the dip on Rocket Lab. I bought 50 shares. There it is. I did. I closed 3 contracts of these puts. Was it the puts? No. What was it that I did was the marathon? Was it the marathon cash secured puts that? Well, the point is I have 63,000 in buying power now. I did buy a long call on Enphase today. So after Enphase absolutely shit the bed on earnings again, I decided to buy a long call 2026 call. Yeah, January 2026. I mean, it's $600. So I'm just playing the long game on Enphase, and I'll just go ahead and sell it. You know, once I'm thinking maybe 50, 100% profit. Who knows? And let's see. Go to total percent change. So I'm currently up on the covered calls on Palantir. Fucking finally. And I'm hoping Palantir trends to 40 by earnings, and maybe I can roll them after earnings. Hopefully Palantir doesn't fly too much, but hey, worst case scenario, excuse me, I'll be rolling these out to $44 or $45 out to next year. Okay, this is my exposure here, the equities. So I have around 6,000 in Tesla, 156,000 in Palantir, 4,300 in Rocket Lab, and 3,100 in OVIX. So this was the move today. Okay, so yeah, so all in all, my exposure to Tesla, so 6,000 here, 6,000 in this account, and 1,000 in the other account. So it's around $13,000, $14,000 in just call options. So we'll see if it holds. I mean, if it holds, if these gains hold, and if Ivy Crush is not that bad, I mean, what are we looking at again? So 4,000. So we're looking at $4,500 of gains, possibly. I'm just gonna round it down to 4,000. So this number we should be looking at 176 grand tomorrow morning. That's the con of options, is that you won't be seeing these huge swings after hours as you would have if I had TSLA shares. But hey, I'm still in it. I pivoted from TSLA into Tesla calls, and I was still able to benefit from today's massive move. So I consider that a win-win. All right, so let's look at the profile. From here, so Martin Shkreli, I hope I pronounced his name right. He was talking about different portfolio archetypes, and he's comparing them to the average retail investor. I thought it was a very cool clip. I'll go ahead and.
Was younger. He had 3. If you want to smoke, I would just do 5 stocks. Just have a crazy portfolio. That's probably one of the few ways. Like Buffett said, he can make 50 to 100% a year if he had to start all over. That's basically the way he would do it. Because that's the way he did it when he was younger. He had 3 stocks at one point, but usually he had like 5 to 10 stocks. I know it sounds crazy, but if you have if you're looking at tons of stocks, you have to do 2 things. 1, you have to look at a ton of stocks. 2, you have to have extreme conviction in those 5 stocks. So when you find stock number 6, it has to be able to be good enough to join the group of other stocks. Most people will say, okay, I can make 30 or 40% on stock 6, I'll add it to my portfolio. But we sometimes call this hurdle rate. You have to say my hurdle rate is I need a double in every position I take. Otherwise I'm not going to take it. I don't care if I can get 50%. I need at least a double. And if you just like have that really rigorous approach, you can do really well. In general, as position sizes go up, your portfolio standard deviation will go up because your individual positions are not going to hedge idiosyncratic risk. But turnover is one of the most misunderstood ones. If your turnover is really high, your portfolio standard deviation drops a lot, and you can afford to have a fewer number of positions. The position size and number of positions are different. So it's very, very interesting, actually. You can have a very low position size with a very low number of positions, but if you have extremely high turnover, this is kind of like a really interesting model where basically you don't lose money and you can still have a pretty healthy return. The Renaissance model, but your win rate should be fairly high. And this is kind of the output, right? The output is returns and standard deviation, or what we sometimes call vol. So here, like, the returns are good and the vol is extremely low if you trade like this. Oh man, this is gold right here. Now, what most people do is say this, which is bad, this, and this. And all this will result in is average returns with very high vol, which is not what you want. Yeah, getting in and out, correct. Which is completely misunderstood, which I can explain some other time, but it's the more you turn over your portfolio, the better, theoretically. Some people even call this velocity. But anyway, Renaissance, so this would be like, I can't even say the name of the guy, but you know, this would be like, I don't know, very desirable. This would be average retail. Yeah, if you don't like to pay taxes, then sorry. Yeah, no, for hedge funds, they don't pay taxes at all, so they don't care at all, but I wouldn't worry if I were you about taxes. You know, you want gains, right? Hopefully you want gains. If you want to smoke, I would just do 5 stocks. Just have a crazy portfolio.
But yeah, so there's a second clip there, but go ahead and you can go to my profile in case you want to watch the other one. But he adds 3 more models, but I just thought it was very, very interesting because that is something that I do notice when I go on Twitter and I see people sharing, you know, their portfolios. And I mean, my portfolio used to look like that years ago too, is where I just bought one share of like 30 different companies because I thought, okay, I want diversity. You know, I want my portfolio to not have big drawdowns, and I want to have a piece of every company. Oh, I like Disney, I like Tesla, I like Starbucks, I like Target, I like Walmart, etc., etc. But then, especially too, is that traders are not typically going to be trading in and out of those stocks, meaning that the turnover that he was talking about is going to be very low. The number of positions are very high. So you have your basically your risk adjusted returns, your vol or the volatility is going to be very high, but with less than average returns or average returns. So you're kind of still taking this risk, you know, even if you're not, let's say you're trying to diversify, right? But you have such low position concentration that you're not going to be taking advantage of these big moves that any of these companies make, right? Like if one of those companies doubles or triples in values, like let's say if I had 30 stocks in my portfolio and they were evenly distributed, my portfolio would not have done nearly as much of the move that it did this year, of it going up, you know, by, I would say like almost 100%, you know, like in the past year, or, you know, I don't know what the exact number is this year so far. But had Palantir done the move that it did, I wouldn't have had the portfolio allocation for it to really make a dent. So just something to think about. And, you know, different strokes for different folks, different portfolios for different people. But check out the other clip. You know, he talks about other allocations, other ways of investing. But for me, I really do resonate with that, you know, aggressive allocation, aggressive conviction in a small number of stocks. And I don't follow him on Twitter. Holy shit. I should. So here, the Rocket Lab accumulation continues. Now I have 1,380 shares. Look at that. L3 Harris and Palantir deepen their partnership. They're now, I believe tomorrow, the CEO of L3 Harris and Alex Karp will be on MSNBC, I believe, to talk more about it. So very exciting, very exciting. So yeah, here I am sharing my allocation on Twitter, showing that 10% of the portfolio is in these calls. So $6,000 there, $6,000 there, $1,000 there. So getting up there. In the Tesla call, Elon brought up Peter Thiel. As soon as he brought up the name Peter Thiel, I'm pretty sure all of the Palantir investors were like, huh? Yes. But the way he brought it up was in the context of flying vehicles. Elon Musk said that Peter Thiel and him are very good friends, and that Peter Thiel has said that the future does not have flying cars. And Elon Musk said that he disagrees. And he's kind of hinting at possible flying robotaxi or flying vehicles. I'm pretty sure they're only going to be autonomous if that happens. I do not want the average driver, the average American, to have their hands on a flying vehicle. No way in hell. And it looks like that's it for today, guys. So maybe this one is a longer video, but I do hope you guys stuck around. I appreciate you guys' time. Thank you for watching. Thank you all here who are on this list who are supporters of the channel. if you don't see your name on this list, let me know. Drop a comment down below and, leave a comment saying, hey, I would like to make it on this list, or add me to that list, and I will. So thank you guys for watching. I hope you guys have a great day, and I will see you guys tomorrow.